Because a downturn in gold would mean that everything else is healing. If it doesn't heal, then obviously gold prices will not go down. Now, we had a huge boom in commodities, as you know, 2001 to essentially July of this year. The commodity markets peaked out the first time in May 2006, and then they went down slightly and moved sidewards until September 18th, 2007. What happens in September 2007? The money printer cuts interest rates from 5.25% down to now 1.5%. And oil, which before the rate cut was at $75, immediately went to close to $150. And gold went up and food prices went up. Now, as money, as I explained, has tightened in the world, as lending standards have tightened, and as we have moved from a period, and don't forget that, 1981 to 2007, it's a period of increased leverage in the world. In the 70s and 80s, brokerage firms and banks, they didn't have assets as a multiple of their equity. But recently, Fannie Mae, they had assets, $1 equity, $150 of assets. The banks and the brokers, they had $1 of equity and between $25 and $35 in assets, all borrowed money. Now you can imagine what kind of risk control you need when you have this small cushion of equity in the system. So now commodity prices went up. They blew out in July of this year. In the process of deleveraging, they get, of course, sold. And as I thought would happen, as the economy slows down, and actually I think the real economy in some countries has fallen off a cliff. In September, we had in the US car sales coming down to a 16 years low. But 16 years earlier, the population of the US was just 254 million. Now we have a population of 305 million. So actually car sales are much worse than they appear on paper. So now commodity prices come down. But I think in the long run, given the fact that the supply cannot be increased dramatically, and don't forget, the mining companies now have a problem that other companies have also, namely how do they finance the exploration? They have no access to money at the present time, or very little. So the capacity expansion in the commodities sector is very limited, and I would say we had in the period 1980 to 2001 falling commodity prices. Now they soared, but we have probably reached kind of a price revolution in commodities whereby it is conceivable that they come down in the years to come somewhat, but of course they will not go back to the level they were at in 1999 to 2001. Like here you have the price revolution of the 16th century. These were the gold shipments from Latin America to Europe that came in following the discovery voyages at the end of the 15th century. And then commodity prices came down, but you can see a new price level was established here between 1640 and 1700, and it never dropped back to this level. And I think commodity prices have gone up. They'll come down here, but they will not go back to the level they were in the period 1999 to 2000. So in general, I would still advocate an exposure to raw materials and in particular to gold. Some people tell me, why do you prefer physical gold to gold mining companies? I think gold mining companies, by and large, are now very inexpensive, that I have to stress. And if you really want to make big money, you should be in exploration companies. But at the same time, out of 100 companies, if 2 will make it, that's about the maximum. It's very difficult to make money in mining. The cost of mining has gone up very substantially. The availability of capital has gone down. And we have also national resource nationalism, where the governments want a bigger stake in the resource wealth they have, which is not favorable for the mining industry. My concerns for the global economy is that we have reached 0 hour. 0 hour means that when you print money and debt growth is reignited, that it has no impact on real economic activity. It just goes into the air, into inflation, whereby the inflation could be in commodities, in real estate, or in equities, or in consumer price or wages or somewhere, but that in real terms it will not have an impact. Because if you look at the economic expansion, 2001, 2007 in the US, you had the strongest debt growth and yet the weakest economic growth of any expansion in terms of employment, in terms of industrial production. The expansion was very loop-sided. It favored people with assets, Wall Street in particular, and the asset shufflers, hedge fund managers and so forth, and the typical family didn't participate in the expansion. The other point I'd like to make is the market began to break a year ago, and it was met with total disbelief because people said, oh, price-earning ratios are not particularly high, except, of course, in your country, they were at 60 times earnings. So it was easy to say that the market would go down here. But by and large, in the world, we didn't have a valuation bubble a year ago. By the way, also in 1929, stocks were not particularly expensive. They were selling in America at 13 times earnings. In year 2000, we had a valuation bubble in NASDAQ, 70 times earnings. In year 89, we had a valuation bubble in Japan, 70 times earnings. In Taiwan, it was 100 times earnings. But this time around, the earnings, the PE on the S&P was, say, around 18 or 20 times earnings. But where the bubble occurred is in earnings. You can see this is the long-term trend of earnings in real terms of the S&P. We were way above the trend. And the reason we were way above the trend is that over the last 10 years or so, the non-financial corporate earnings in the US, they hardly expanded. They expanded overseas, but not domestically. What expanded dramatically in the last 10, 15 years is financial sector earnings. And by financial sector earnings, I mean not only the earnings of brokerage firms and of banks and of insurance companies and so forth, but also the financial subsidiaries of industrial companies and the treasury departments of industrial companies. They made a lot of money, like GE Capital, General Motors Acceptance Corp. They all went into subprime lending sectors and so forth. And that drove earnings way above the trend line here, as you can see. And now the financial sector is broken. That is very clear. The bubble, the credit bubble has burst. That is a very clear signal that the fundamentals of the industry have changed. And so I don't think that earnings will be increasing much in this sector, and that earnings for the S&P, by the way, the strategists and the economists, they were still until recently estimating $110 S&P earnings for next year. So on the basis of, say, an S&P at 900, it would not be terribly expensive. But my sense is that earnings will collapse, as they've done already in the last 6 months, and they'll stay down, no recovery. And in some cases, they may even go and contract further. So the valuation of stocks, even after the recent decline, is not terribly compelling. Now, I concede that the markets worldwide have become unbelievably oversold. Statistically, we never had such an oversold market as right now. It's like if you drop a tennis ball on the floor, then it rebounds